Okay, so looks like we're 9 minutes in already, so we can go ahead and get started. I want to welcome everybody again. Thanks, Evan, for joining us, and Walt, and Jonathan, of course, Shayna, Anissa, and John. And if there's more out there, I'm sorry I can't see you on my screen, but I don't know what the story is there. But so we're continuing on today. Last week, we recapped several of the core principles from the very first two sessions, edition 1 and 2. We talked a good bit about the trends. Shayna asked a good question there, and we talked a little bit about what's happening in an M&A. She's receiving a lot of inbound queries, and she and her partner met with me yesterday to talk a little bit more about that in detail. And I don't know if a little later you want to share any of your thinking on that, Shayna. Then we talked about the 18 traditional and the 6 non-traditional resilience drivers. I had a very interesting experience this morning. I sat in on a very early morning broadcast with a private equity network where they were discussing, what is private equity looking for right now. And what was interesting to me is that they were all entangled in the sort of the traditional revenue earnings debate. And what do you do when your Q2 earnings and your EBITDA has dropped off the radar screen, and you didn't do anything wrong per se? There isn't a trouble or problem in the business. It's that business stalled by virtue of the coronavirus. And how does that get reflected in valuation? Just to give you the crux of the biscuit, my contribution to that meeting was I explained that if you have sound fundamentals, which is what we're going through, and you have a historic record of performance at or above, or at least near projections, then there isn't any logical reason to penalize the valuation of the business for the Q2 event. The exception, of course, to that being if your business is a business that relies on industries that will probably not be recovering in an effective manner, then you have to factor that in. But I think that would be factored in to Q3, Q4 projections into Q1, and that would then be an accurate reflection. So my proposal for the clients I'm working with is that we'll take a look at those factors. If everything looks sound as it should, clearly if they're following our recommendations, then we can do a straight line map across end of Q1 into Q3. And the only thing you have to determine is what's the slope of that line. But once you have that, you can actually get a reasonably good starting point for valuation Q3, Q4, and Q1. So that way the company is not being inordinately penalized for something that really isn't an indication of any failure of the business to perform. And I think that's probably a reasonable approach. I'm finding that the investors that I'm meeting with and the private equity firms and strategic buyers that we're meeting with find that to be a very reasonable approach, particularly if we can back it up with the data, which turns us back to, the work we're doing here on this call, and the work I hope you're doing as a result of the insights you're gaining from all of this, to actually establish and maintain the good fundamentals, which will provide the basis for that argument, right? So I think I used as an example last week, Jonathan, who's with us again today, that, we just closed part of a round of funding where we were able to navigate that process quite effectively. And although the process had started prior to COVID, clearly there's a lot of upside potential in the application they're developing, so that we didn't take a hit on valuation at all. In fact, we a little more than doubled the valuation of the business. So, so there's a lot of ways that you can skin that cat. The key, though, is having the sound fundamentals. And I mentioned before, and I'll say it again, Jonathan's team has done just an outstanding job in those things. I mean, when he's undertaking something that's extremely difficult for a company to pull off, and they're doing a great job with it. Along the way, they're actually pulling all the important fundamentals with them. So,
Thank you.
thanks for that, Jonathan. Right.
Well, thank you.
We also reviewed the resilience and accelerated recovery components of those traditional and non-traditional value drivers. We reviewed how an exit strategy is used to identify specific value growth accelerators, and of course those reflected in resilience accelerators. And we discussed, finally got around to the finance operational resilience driver and spent some time on that. This week, we sort of go into a little bit different area. We're going back over to the market drivers. And when I was putting the outline together for today, I was reminded of a story that I'll share with you. As you guys know, what we do at Zero Limits Ventures is we focus on developing valuation growth strategies for our clients. And we develop those in a way that allows us to raise capital at a higher valuation, therefore affecting lower dilution at capital acquisition. And of course, at the other end, in an acquisition, we're able to garner significantly higher returns on the acquisition of the company as a result. And those are all qualitative metrics for that. Some years ago, I was on the phone with a good friend of mine, an associate who's the managing partner of Satori Capital. They're probably the largest impact investor, private equity investor in the world right now. And I was explaining our process to him. And I made the comment that in theory, the work we do diminishes in value the higher up the revenue curve we go. In other words, we have a very high percentage impact on companies that are in the $5 to $50 million range. But on a percentage basis, that impact goes down from 50 to 200 million. He thought about it for a minute and he said, I actually could not disagree with that statement more than you can imagine. He said, it's so wrong. You have to rethink your entire strategy there. And what he referred to is something, I'm going to clean up what he said, is that when they do their due diligence on a company bound for their portfolio, they create a list. And that list is called the I can't believe they don't know this list, right? And so what ends up happening is when companies are established and are growing, there's a siren's tendency to take your eye off of these fundamentals. When there's plenty of cash and things are going great, you stop paying attention to the little nitty-gritty things that really matter. And what ends up happening is you get far enough down the curve that you're no longer in touch with some of these critical fundamentals. And when it comes time for some significant event, investment, partnership, acquisition, could be, a number of different things, you really don't have the answers you need to the questions that are going to be asked. And that puts you in a very compromised position because, going back to the overriding fundamental, that creates risk. And what does risk do? It reduces value. So, the admonishment here is to go through the process and, read through the tea leaves, use the tools that we're giving you, and really understand what they're telling you about where you need to focus your time, energy, and money to secure and, solidify those foundational elements, because those are the things that are going to make all the difference. Whether it's short-term or long-term, doesn't matter. You want to put in place the methodologies necessary to establish and maintain these fundamental drivers so that you can, on a moment's notice, provide any perspective necessary about the performance, the resilience, recovery, and value of the business. So today, we want to talk a little bit about the business and revenue model. This section of the process is where it's looking at all these different elements of what does your business actually do, and how does it actually go about doing it, and how does it actually produce returns in revenue and earnings, and value to the consumer and so forth, right? So the goal here is that you and frankly all of your uh, uh, employees can actually communicate, or all your stakeholders really can communicate and articulate the business model, the product roadmap, and that you maintain both historic and projected operational performance models. The idea here is that you've heard me mention this several times in the past. Uh, you know, when you drive a car, there are all kinds of instruments and gauges in the dashboard, and most of us don't pay attention to most of them. I remember way back when cars had all gauges and, no idiot lights, right? Now we call them idiot lights because the thing flashes on when you already have a problem. Well, the idea of the gauges was that you could see a problem developing, and you notice that your oil pressure has been lower than normal for a little while. You might want to go have your engine checked out or things like that. Maybe do an oil change, make sure you have enough oil in the car or something like that. So running a business is similar. An analogy to that is that there are all kinds of indicators. You could look at these 24 as really key indicators of the soundness and the operational effectiveness and efficiency of your business overall. So, if you know where it is right now and you see something fall out of normal range, you can explore that and find out, well, what happened? Is this a new trend in an industry? Is this, what else is going on? What are the market or environmental impacts that are affecting what is a normal performance of our business? If things go the other way and they're getting, your redlining performance, which is good, you might also, though, indicate that, hey, where do we need to add capacity? Where do we need to improve process? Where do we need to make adjustments in what we're doing so that, we can bring the performance of the business back into a stable mode? So I remember years ago, I had a client who we were talking about doing the assessment for him, and he was on a very aggressive near vertical growth. His value was not driving at a rate as fast as his revenue was driving. He had Bay Area investors who were only growth oriented, not oriented in qualitative metrics at all. And so he had influence from them that was saying, keep going, revenue at all costs, profitability be damned, sound principles be damned, grow, 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 grow. And I sort of gave him a warning and said, well, I understand your impression there, but I think it's a mistake because those are the kinds of businesses that flash out, right? Because anything that happens and you're not prepared for it, you're in deep trouble very, very quickly because you're going deeper and deeper into debt to finance this rapid growth. And if something happens in the market, a regulatory change, a customer problem, something like that, you can find yourself in the poorhouse very quickly. Well, he didn't take that advice. And it wasn't long ago, I ran into one of his employees at a conference. I said, how'd that work out? He said they shut it down about 18 months later. So, it's important that you really pay attention to these things. And what I'm suggesting is that you think of creative ways to take these fundamentals and monitor them. So it's start understanding where you are. Then it's understanding where you are tells you about what you need to do. And then it's about understanding how is what you're doing affecting the realignment of those metrics, if you will, or those representations of the performance of your business. And then it's a matter of how frequently do you monitor all of those gauges, so to speak. So again, back to the automobile analogy, back when there were gauges everywhere, if you were on a long trip, you would start to monitor things like engine temperature in the summer and so forth. And you would watch that, how this was performing, and you would take action accordingly. So that's really what we're talking about here. So in terms of the business model, some of the metrics that you want to be thinking about is look at your sales as a function of distribution. In other words, how much of your sales volume, what percentage of your total sales volume is related to direct sales? That's either online or offline, but but revenue generated directly to you from your prospects and your customers. If you have indirect sales channels, what percentage of your business revenue is produced by those indirect channels? I'm going to talk a little bit more about this in detail, but what percentage of that number is committed revenue, right? Then the question becomes, are you selling B2B? Are you selling B2C? Or are you doing both? And if you are doing both, what's the percentage breakdown of those aspects of the business? Then, of course, whether or not you're online or offline, what are the elements there? Each of the understanding those metrics. So imagine having, a percentage-based gauge for all of that, and that, you start today with a representation of your business that says 80% of our business is direct sales. Of the direct sales, 40% of it is offline and 60% of it is online. That's extremely useful context, right? Then, and let's say it's B2C, right? And then let's say then you have B2B sales that are through an indirect channel. So you're able to sort of see all of those different aspects as they are right now, historically. That number one will be very revealing to you in terms of where are you strong and where could you use some adjustment, where could you use some action. Keep in mind the overriding principle: reduce risk increases resilience and value. So if I looked at this and I said that, well, most of my sales are direct, they're mostly B2C and mostly online. Okay, then the question I would ask is, are there indirect channels available to me that I'm not utilizing? Is there a B2B sales opportunity that I'm not recognizing? And is there a way for me to increase my offline sales to match the volume of my online sales? Now, the answer to those questions may be no, but the point is you want to explore those possibilities. And if you have these instruments on your dashboard and you're reviewing the elements of your dashboard every month, you're going to be reminded every month that you want to look at ways that you can improve all of these things. Because the more accurately you can predict or project what your normal performance is on a percentage basis, the more effective and the more valuable and resilient your business will be. So that would be an area of the dashboard I would focus quite a bit of attention. Then you want to look a little bit about, the business model itself in terms of what are your client or market engagement strategies. Years ago when we were selling software that sold for between $1 million and $5 million a deployment, something I think, Jonathan, you're familiar with. And, those are heavy duty sales engagements. Those aren't the things that you're going to, no one's going to, do $1 million order on Shopify. Okay. So it took relationship building. It took, proof of concept. Sometimes it took evaluations. It took, bake-offs and other kinds of methodologies to actually get those transactions done. That was challenging. But the good news in that is it forced you to really deeply understand both the sell cycle and the buy cycle. I have to say, I've been on so many calls here, I honestly don't remember whether or not I've spoken to this issue with you guys or not. So if I have, then I apologize for repeating it. But if I haven't, then it's going to be useful for you. All right. So we all have this understanding of what a sales cycle is, right? It's the notion of a funnel where you put a bunch of stuff in at the top and some of it bleeds out right away. Those are unqualified prospects. And some of it might go to the next stage of considering your solution. And they're going to do whatever they're going to do in order to evaluate that. And the idea is the volume reduces down until what comes out the bottom are the customers that flow out of the volume of input that you put into the funnel. The idea being that, it's not a pipe. You don't get every deal that comes and looks at you. There are things that happen along the way that cause people to choose an alternative or to choose not to buy from you or whatever the case might be. Well, so understanding the sales cycle is important. And this is the thing that, you train your salespeople to attend to. You train, Oh, I need some water. Your marketing people to attend to, and in the context of an online or an e-commerce business, excuse me, you're basically doing the same thing through the instrumentation that you have in the design of your sales funnel. So you're seeing where people opt out or where people, you know, don't finish a transaction, and you have processes to recapture them and put them back into the funnel, things like that. So that's all well and good from the sales funnel standpoint. What you need to understand, though, is that funnel means nothing if you don't understand the buy cycle. And here's the thing I'm saying when I say that. Every person, every individual goes through a well-defined process of making a buying decision. And it doesn't matter if you're buying a stick of gum, a house, or a business. You're going to use the same process to make a decision. Now, in the case of a stick of gum, you're going to run through that process pretty quickly. It's not even going to be visible to you. In the process of a house, it's a little bit more arduous. The process of business, it's more arduous still. But it's still a process. It's a well-defined process. And there are certain aspects, there's certain information, there's certain things you need to see, hear, smell, touch, understand as you progress through that process. So if you were to know as the merchant what the buyer's actually thinking and what information they need to see, hear, smell, and touch in order to make a buying decision, then you can match your sales process to the buy cycle. So this is why I've always said it's more important to understand your buy cycle than it is your sales cycle, right? So when I was working with a number of top tier VC firms out in the Bay Area, people thought I had some magic powers because I was able to step into a troubled situation and very quickly get the company on a high valuation trajectory and move it to exit to clean up their portfolio. And, I let them think that was okay. That worked to my advantage. But the reality is what I was doing is quite simple. The very first thing I would do is go meet with, as many of the top customers as I could get in front of. And I would ask them, how did you go about making the decision to buy this piece of technology? And they would explain it to me. Well, we first looked at this and we first compared it to that. And then we did a bake-off, and then we did a technology evaluation, and then we had you do an evaluation, and then, whatever the process was. And over time, you get enough consistent data, you can say, okay, this is the decision process that people who buy this kind of technology go through. So all we have to do is go back to our sales and marketing department and say, okay, we want information, demonstrations, evaluations, whatever that matches these decisions. So that if we know that one of the decisions they have to make is, I don't know, one of them for us was the SLA, were the terms of the software license agreement acceptable to the client. If we kept tripping on the SLA as a decision criteria, then we would go back to the legal team and say, we want a better SLA, something that doesn't trip our clients up, right? So the point is that understanding this part of your business model allows you to create more efficiency and, importantly here, more predictability in your sales and in your revenue production. And what does predictability do? It reduces risk. And what does reducing risk do? It increases value. So this is why understanding this dynamic of your business is so critically important. Evan, I don't know if you're able to unmute, but you're in an e-commerce space. And so you guys do a lot of instrumentation and testing, right? So you utilize this principle frequently. Do you have any thoughts on what I just said? If you can unmute and share. If not, that's okay. He's probably just poaching the call and getting the recording later. Yeah, I do the same thing. All right. So another question is, how many channels of distribution do you utilize? I remember, I think I told you the story of our friends, the Umlaufs over at 4K9s, that they had one channel of distribution. It was a very good channel of distribution, and they produced a tremendous amount of high margin business through that channel. However, from the standpoint of risk, that is an extremely high risk profile, right? So you want to reduce risk, and to do that, you need to understand what other channels of distribution are available. Now, in that case, what we were able to do is step outside the box a little bit, and we started talking to companies like Ford Motor Company, IHG, Zipcar. We looked at what are other ways that we can bring this product to market so that we can increase the range of channels that are addressing the market demand. Giving up a little bit of margin to get an increased breadth of market is a risk reducer, right? So while your profitability overall may drop off because of the channel, your reach is going to increase in a way that far exceeds the loss. So you're going to get more breadth, more revenue, but more importantly, you're going to secure a lower risk profile in the distribution part of your business, right? So whether you're using affiliates or value-added resellers or OEMs or integration partners or whatever the case might be. If you're, for instance, we have a client that we're just getting started with. By the way, Anissa, we got the thumbs up on that transaction just the other day. Then they are today and have been 100% offline retail, very traditional brick and mortar. Well, before all of this happened, it was very clear that while that was very solid and they have a lot of different points of distribution, a lot of different products they represent, there's risk. And the risk was they weren't taking advantage of the highest momentum channel available to them, which was online sales, direct to consumer online. So one of the recommendations we made was to make sure that we bring up the online distribution capacity of the company so that it operated on a percentage basis in a way that was reasonably scalable to the retail storefront part of the business. Because not only would that add revenue, of course, it added to the margin line, of course, but more importantly, it increased the range of channel distribution, which reduces risk and increases value. So putting those things in place, just building the online presence, even if you don't produce the full volume productivity out of that online infrastructure, it's still going to increase the value of the business because if you have multiple channels of distribution, right? So far so good. Okay, so now when we think about distribution channels, it's great to have other companies representing what you have or what you do. That's a good thing. The next question is, can you get that channel to make volume commitments, right? Remember, predictability is the key here. So if I have a reseller or an integration partner or an OEM partner, can I establish that relationship in such a way that they're committed to a certain predefined volume of purchasing? Because if I can do that, I've now increased the predictability factor of my business, which is going to reduce risk and increase value, right? It also opens up an opportunity for negotiations of future revenues when you need bursts of growth. So to give you an example, years ago, a lot of the software that we sold went through integration partnerships and distribution channels that had relationships with the enterprise clients that we wanted. So rather than go in and try to sell the enterprise client directly, we went in through a channel that already had the relationship. And so we'd do a deal or two and they'd make good margin. And so we'd establish the relationship. And then the next conversation was, okay, so you like our product, you like the way we supported you in that process. We're willing to give you more of our margin if you'll give us more of your business, right? So that there becomes a negotiating component of that relationship. Ultimately, it gets to a point where you can say, okay, tell you what, we're going to take you from 25% margins up to 40% margins, but you have to make a quarterly volume commitment of XYZ, right? Then they might agree to that, but you get that in place. Then let's say you get 6 or 8 months down the road and you're looking at a strategic partnership or an investment round or an acquisition, then you have another lever. You can go back to that existing channel and say, hey, do you think you could move more product if we made it worth your while? If we took your margin to 60%, could you move 40% more product? Right? Now, what you're asking them to do is make your product a higher priority in their sales and marketing effort. They're going to make more money by doing it that way. So now there's appropriate alignment in the incentive that's actually going to drive value right into your business, right? So this is why having these volume commitments and contracts in place with your partners, with your distribution partners, makes so much sense. Does that make sense to you guys? Okay. It's particularly the case in complex system sales like yours, Jonathan, and Shana, particularly the case in transactions like yours, where, I mean, you're the preferred vendor in a number of key contracts. That's a good thing. But there are, there's other vendors in there. So if you could partner with them and over time create volume commitments around those partnerships, you increase the predictability of your business and boost value. You might give up a point or two of margin, but you're going to make much more of that by getting the added value of broader distribution, right? Okay. So then so now you envision you've got your direct sales, you got your indirect sales, you got, all these different channels going, you've instrumented all of it, you're doing your dashboard reviews, you're watching the numbers on a monthly or quarterly basis, you're seeing where the dynamics are, you're seeing where you can make additional investment, you're seeing that, hey, our distribution volume through our reseller channel has dropped off a little bit. Let's go out and knock on some doors, have some meetings, have some lunches, talk to them about increasing their volume and how we can help them do that kind of thing. So you have lots of different ways to drive the predictability of your business. Now the question becomes, how do you go about cultivating those relationships, right? What are you going to do with those people so that you're not just another item on their price list or another element in their catalog? Some of the partners that we had, they would represent 50, 100, 200 products, excuse me. And so, being the one that the salesman preferred to pull out of the bag was an important thing, right? If you were just another one listed on a brochure, you weren't going to get much traction out of that, even with a volume commitment from the executive team. So, what are you doing to actually cultivate those relationships and deepen the trust and confidence of them as a partner? Some of the ideas that we used over the years, we'd have partner groups and meetings. I don't know if you've ever heard of a local users group, but in certain areas of the country where you have a collection of customers, it's a good idea to go in there and spend a day giving them an update on the technology that you're building, give them as a visibility into the product roadmap, treating them like they're special because they are special, right? But you can do the same thing with your partnerships and with your strategic channels. Is give them the opportunity, and also, of course, you give them the opportunity to say, hey, we could move a lot more product if you package it this way, or if you delivered it that way, or if you gave us better training, or whatever it might be. Then you're actually able to move those dials. Remember, envision that dashboard where your dial is set here, and boy, they're saying if we gave them a little training, they could get up to here. Well, that would have a huge effect not only on my business but on the value of my business, right? So lots of different ways that you can actually cultivate those relationships and get those relationships producing. I know one of the most successful salespeople in the enterprise software industry, and I know from firsthand experience, the secret to her success is she manages channel relationships better than anyone I've ever seen before. Right. And, she'll move into a new territory and pretty soon, she's just floating by, revenue's churning. She's got hundreds of people in her marketplace that are out there selling her software. She's just doing second tier sales support, second tier tech support, that kind of thing with her team. And it creates an extremely predictable and fast growing channel of revenue. And, year in and year out, salesman of the year, salesman of the quarter, salesman of the month, year after year after year after year, 27 consecutive president's clubs, if you can imagine that. She's never not been awarded the number one salesperson, things like that. And it comes from developing these relationships. That's the crux of the entire thing, is she cultivates relationships. she makes her product and her company a priority for her partnerships, and they put them first because they're generating greater rates of return for themselves as well. Right? So think in terms of how you can leverage the partnerships around you. If you don't know who they may be, talk to your customers because they know who they are, right? And I think I covered a couple of weeks ago this concept of co-opetition, right? So, I look at competitors as a good thing. If I'm in a market that has no competitors, I got to get a little worried about my decision to be in the market I'm in, right? So I'm glad when there's competitors out there because number one, it validates that I'm in a decent market. But number two, it gives me opportunities. I remember years and years ago when I was selling disk drives, if you can imagine that. This is back when disk drives were the size of refrigerators, right? And there were two companies in the DC area that were leaders in the industry. One was Microtechnology. That was the company I worked for. And our number one competitor was a company called Systems Industries. And there was one sales guy there that was my nemesis. I'd get tied into a deal at NASA or something, and lo and behold, he'd get in there at the last minute and mess up my deal. And the funny thing is we became great friends and respected each other a great deal because we were constantly doing battle. One day, literally, we run into each other in a restaurant. We decide to have dinner together, and we're sitting there talking about it, and it dawns on us that we could do a lot more if we cooperated than if we continued to beat ourselves silly, winning deal after deal, right? And so it became much more strategic to engage the market on a cooperative basis, and we could actually leverage the advantages of each other's technologies. And you can imagine the look on the customer's face when an MTI sales rep said, for this requirement, I actually think you're going to be better off going with Systems Industries solution, right? And then later down the road, they would do the same thing, right? And it became a very effective way of managing the market to our mutual advantage and delivering value. I mean, we didn't take our eye off the ball. Frankly, there wasn't a bean's worth of difference between our solutions. And all the competitive posturing was about, feeds and speeds, and none of it really mattered in the end. So it was a good way to engage the market. So don't discount competition as a potential partnership that could lead to some business you wouldn't otherwise get. So then the next element to look at is in your revenue model, what is the distribution of your revenue across new business, repeat and add-on business, and continuity or contracted auto build business, right? So how is that actually handled every month and every quarter? Imagine, and I think that most companies would find this to be true, that their buying market moves in cycles or waves. And that at certain times of the year, you're likely to get more new business than repeat or add-on business. At other times of the year, you're going to get a lot more add-on business. This is particularly true with government budget cycles and so forth, but it exists the same way. The reason you want to know what the fiscal year is for your client is you want to be in a position to tap them on the shoulder at the end of the fiscal year and say, hey, you guys might need to move some capital. We've got a way for you to take more product, pre-purchase at a higher discount. That helps me, that helps you, right? So really understanding how the dynamic of new business, add-on business, or continuity business moves through your business model gives you more levers of control. And as you do that, you're creating more predictability. And predictability reduces risk, creates resilience and value, right? So, so those are important aspects. So envision the dashboard where you're able to monitor all of those aspects at one time in one review, whether it's monthly, quarterly. I don't think it should be more than quarterly, but some do it in a broader, a broader time horizon. The next thing we want to talk a little bit about is the importance of recurring revenue. And I've mentioned it throughout this, so we don't really need to labor it very much. But recurring revenue appears in a number of different ways. This is, particularly significant for businesses, the SaaS businesses like the one Jonathan is building, where the reason they're getting such massive multiples at acquisition is because the revenue is so predictable, right? You're monitoring on an ongoing basis monthly revenues, monthly rate of revenue return and growth. So it's, it makes it much easier to rely on the projections of the business when you have contracted or continuity revenue in place. And the overriding factor, of course, is that you're reducing the risk for investment and acquisition. Now, if you don't have a product that can be sold on a subscription basis or on a recurring subscription basis, then you want to look at, are there ways we can obligate our customers through volume contracts? Is there a way that we can pre-negotiate licensing so that over time we know they're going to purchase a certain volume of software, a certain volume of hardware, and you can give them applicable discounts for certain volume commitments or whatever the case may be. And again, while you might be eroding a little bit of your margin, that is going to be completely eliminated from the equation by the increase in value of the business. It's a slightly different application of the same principle, but a lot of times when I'm speaking to investors, particularly private equity, about the importance of an impact mission, a lot of times you're talking to people who don't recognize the value growth potential, and they're seeing it as erosion of margin. So we've actually had investors say, well, I'm not willing to give up 15% of the margin, just to, house the homeless in Haiti. Well, okay, I understand that. That looks painful, and you are going to lose 15% of your profit margin. But what if I told you that 15% was going to give you 400% returns on the back end? Right? Then it would be a foolhardy to not take that opportunity. So it's the same process here, right? It's the same basic idea. Okay. Then the sort of final factor I want to talk a little bit about is the concept of retention. So, we talk a lot about customer acquisition, lifetime, cost for acquisition, whether it's measured online or offline, doesn't really matter. There's just a different set of factors you look at to calculate the same figure. And, we look at those relative to forecasts, and we look at them relative to the distribution that we just talked about. We have all those gauges and dials that are representing, what the business is, how the business is performing month in and month out. But as you all know, it's a lot easier to build on that volume if you're retaining customers. So one of the second reasons why SaaS businesses become so valuable so quickly is because they've got built-in retention. You take a piece of software and you deliver it as a service. You're now tapping the expense line instead of the capital acquisition line. So that makes it easier for your customer to buy. But more importantly, the switching costs for that software become very, very high. So they're making a long-term decision that works to your advantage because the likelihood of losing that customer diminishes over time. The longer they have the investment, the longer you've retained them, the less likely they are to switch, right? So retention becomes a critically important factor of resilience and value. There are a lot of ways to create it, but you want to look at, we invest all this time and money in acquiring customers. What do we do to retain them? How do we make sure that these customers continue to derive value out of our solution and that they're in a position to purchase more of our solution, or at a very minimum, continue to support the deployment we have for the longest period of time available? In the online space, we refer to lifetime value frequently. That usually is a formula that considers the initial purchase, any potential add-on purchases, and the longevity of subscription volume. So, I did this arithmetic years ago when I was deploying my first online product, my first e-commerce product. You had to do the calculation. We could get the initial order for $297 a unit. And then, we would retain that client for let's say 3 months, or we could get the initial acquisition for $97 a unit and we could retain that client for 15 months. So which one was more valuable? Well, even though the price was half, the lifetime value of that customer was much greater at the lower price because they stayed with it for a longer period. So that's a calculation that you want to look at regardless of the business model. It works the same way as in any company selling any product. But you want to make sure you understand you're making an investment in acquiring a customer. What is the time value of that customer as it relates to lifetime value of revenue to your business, right? So anything that you can do to increase the lifetime value is going to increase value in the business, resilience and value in the business, because you're reducing risk, right? So far, so good. Any questions on any of that? Sorry, we lost Jonathan along the way. I was hoping he might be able to comment on that. Okay, well, so that's what I've got for today for that market driver. Again, sort of the visualization, the visual I want you to have is, think about all of these metrics on as a functional element of your monthly or quarterly review of the business. You can think of it, you can look at them in spreadsheets, or you can look at them in dashboards. I used to like to look at things in charts because I could very quickly see how things were changing over time, but everybody has a different way of viewing the data. Do we have any questions about how to do any of that?
I got a question, Steve.
Sure, John.
Let's talk about increasing clients and retaining clients. Just a thumbnail sketch. When you're looking at a business, it's going to depend on the dashboards, etc. What's your quick mental model as to, do we go out and get more clients, or we really got to focus on retaining clients? What's your quick thoughts on that?
Well, I think it really revolves around that lifetime value number, right?
Okay.
So if I start from day one, and I know, let's say the lifetime value of $100 client is $2,000, right? Then I know for every 100, I'm actually putting in place a $2,000 opportunity for me. All I have to do is retain that client for the duration of time necessary to get to the $2,000, right? So that's going to drive my actions. It's going to tell me that, okay, I'm willing to take the $100 client because I know that that client's going to bring me $2,000 over time if I do the right things, right? So once I know what those things are, I now have increased the predictability, and every $100 acquisition is going to bring me $2,000. So if I knew that and I had a high degree of confidence in it, what am I willing to pay for the $100 client? I mean, it's obvious that if I only paid $40 for a $100 client, I would spend all the $40 I could spend, right? But if I had to pay $150 for the $100 client, I'd be willing to do that if I knew I was actually getting a $2,000 client, right? So understanding that dynamic is really the answer to that question, right? Because the lifetime value has a lot to do with how is the client retained and developed over time, right? And that's what you're really acquiring when you acquire the customer. Hey, Evan, glad you could make it, man. I called on you a little while ago, but you were maybe on another call or something.
Sorry,
I told them that you were poaching the call and probably going to watch the recording. So.
Oh no, I've been listening. I've trying to do a million things this morning and playing a lot of catch up. Love the deep dive. Like, absolutely one of the coolest things I've ever done, and I love how simple and how straightforward it looks to add value to the business. I've got a question on this, Steve.
Yeah.
I'm looking at our partnerships. We regularly, I mean, we've still get a lot of word of mouth referrals from people that are, kind of high level like yourself. Thank you for the one to Bucked Up. That was great. Good client. So I'm curious, we're a services business. A lot of our partnerships right now are structured really informal, like paperwork that's like a 2-pager that says, what we're going to pay you, or just refer people back and forth. I'm curious if it's better to have it documented or not documented. What are kind of best practices to increase the value when it comes to, I mean, it's
Yeah, no, absolutely.
all sorts of companies.
It's probably not going to come as a surprise to you, and I know it won't come as a surprise to Anissa, is, document, 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 right?
Mhm.
The reason for agreements are not about when everybody's getting along. They're about when people aren't getting along, right? So you want to have agreements in everything. I mean, I'm going to branch off and I'll come back to your point, but just the other day, I had someone call me and ask me for a reference on someone, and I was uncomfortable providing that reference. And of course, they wanted to know why. And I said, well, I can explain it, but it has to be protected under NDA because, I would then be liable, right? So, if you want to sign an NDA, then I'll give you more detail. However, the conclusion is going to be the same. I can't recommend that person.
Mhm.
So, years ago, I had that advice from my HR executive who said, when people call for a reference, the answer is just no, I can't give a reference. That actually tells them everything they need to know, right? So now that's not a good example for what your question is. So the point is that, yes, I think every agreement should be documented, even if it's just a simple exchange of referrals, right? So if I say to you, Evan, I'm going to pay you 10% for anything that I generate from any name you give me, right? And let's say I do that, right? And there's no agreement in place, then neither of us has been value affected by that, right? I mean, so, okay, we're going to do a financial analysis in the future. They're going to say, hey, what's the $10,000 you got from this guy Little? Well, it was a $10,000 commission for referring him to this $100,000 client. Okay, well, that's great. How is that counted in terms of value in your business? It's not, right? So if we have an agreement where I say, hey, sign this agreement, it commits me to pay you 10% for every 100,000 or 10% for every order I get or give you, or every referral I give you, or you give me rather, sorry, then now you have something that actually has a value effect on your business. Then the question becomes, how frequently does he do that? Well, he's only done it 4 times. But Evan, if you recognize that as a value driver, wouldn't it be in your best interest to refer people to me?
Absolutely.
Now you're driving value in your business because you have an agreement that says when I refer people to him, I get 10% of what he does. It's great that I make that payment anyway, right? Even people I've never had a conversation with. John was one, actually. I spoke at a conference in Baltimore. The host of his conference had put the group together. I gave the presentation. Jonathan signed on with us. I sent that guy a check. He called me and said, what's this for? I said, well, one of the people in your conference bought from me. He said, well, we didn't have an agreement in place. I said, well, you want one? That's what's important, right? So for him, it drives value if you have those agreements in place, right? Regardless of the structure of the agreement. I think you were busy during this phase, but we talked a little bit about channel partnerships and distribution partnerships and how they can be leveraged assets for your business, right? So a lot of times it starts out as an informal relationship like that, then it becomes a little more formalized because if all of a sudden, you're making 5 or 10 referrals a quarter to me, that means that there's probably a significant overlap in our market that we should be leveraging more effectively. So instead of paying you 10%, I could say, well, I'll tell you what, Evan, if you can commit to doubling the number of referrals, I'll pay 20% on each referral. Now I've got a leverage point to double the referral business in my business and pay you more money. So we both gain value, right?
Mhm.
Then, we get further down the road, maybe we're a couple years in, and now that's a regular recurring thing. And I say to you, hey, Evan, tell you what, if you can commit from a volume perspective to sending me 20 people per month, I'm going to take you up to 30%, right? So now I can use that contract and that relationship as a way to really generate more predictability in my business. And when I generate more predictability and you generate more predictability, the value of our businesses go up.
That makes a lot of sense. Can I ask like a follow-on question to
Yeah,
that?
of course. Yeah, that's what we're here for.
So, so Wooly, the guys who I think you were on there, the
Yeah.
dinner with those guys, asked me to commit to 10% back and forth. I mean, we passed them, one of our clients that signed up. They want to do referrals, they want to do co-marketing,
Yeah.
every quarter. They want us on their website. They want us on theirs, which is great. Do I document all of those things? Is that part of the
Absolutely.
referral relationship? Okay.
Absolutely. And you should associate a percentage of that remuneration with each of them, right? I mean, it's one thing for us to have a casual relationship where I say, hey, you send me a name, I'm going to pay you something,
Mm-hmm.
right? It's going to be 10% or so, right?
Mm-hmm.
That's informal. Then we formalize that. Well, then, you want to put my stuff on your website. Okay, well, that's great, right? Or vice versa. Well, that's great, but, that's going to cost you some money because you're using my landscape and my brand now, right? Because I'm paying for that brand, right? I mean, you're paying for that web presence. You're investing in your marketing. You're investing in your brand development. That's an ongoing expense to you. If there's somebody else going to benefit from that investment, then they should pay for that. So the margin has to go up, right? It's just like if it goes to the next step, and let's say it's a little different in your business, I realize this, but let's say the next step is you're actually selling their product. You're selling their service for them, right? All they're doing is taking an order. Well, you should get paid pretty handsomely for that because they don't have any investment in that customer, right? So, there needs to be a structure to the relationship, and that structure should mirror or reflect, what are the aspects of the relationship that each is investing, right?
Got it. Okay. I got to give some more thought to that, but that makes sense. I'm thinking about formalizing like all of our partnerships, because that's a good lead generator for us. So that
Well,
makes
it's
a
a
lot of
huge
sense.
value driver for you, and if you can manage the relationships effectively, as we spoke earlier, then you can actually create more predictable revenue for yourself. I mean, and that's the key right there, is leverage a channel. It's great to have friends in the marketplace. It's great to have people who have goodwill for you. That's all good. But if you have a sufficient amount of interest, which it sounds like you have with these folks, then put some structure around it, right? Make some
Mm-hmm.
commitments to each other of how that's
Mm-hmm.
going to work, right? And
Mm-hmm.
then review those commitments and see, are you making the commitments? Are you missing the commitments? What could be done differently to optimize the commitments being made, right? And one thing leads to another, and pretty soon you have a value-added partner who's generating massive volumes of productivity for you, and vice versa, and you're both making very good money just by virtue of the relationship you established, right? But it
This
can't
is
happen without the documentation because there's no value associated with an arm's length relationship.
this should be written by attorneys, it sounds like, as opposed to myself, or can it be
Well,
that
I mean,
informal?
I always start with, I start with a boilerplate.
Mm-hmm.
You can do a Google search. You'll find about 500 different
I've
options,
got a Rocket lawyer account,
yeah, and
that's
then just
for referrals.
tweak them to match. I
Yeah.
mean, so I'll start with a boilerplate. I'll come up with the terms. I'll negotiate the deal we want. And then from my perspective, I always run it through counsel because I have so many securities, concerns. I have to be very careful about that. But, for the $300 it's going to cost me to have an attorney dress it up the way it really needs to be, it's worth doing, right?
Cool. Yeah, I'll probably have to do it once over at some point with all my agreements a little bit down the line, I think, just based on where we're at.
It's a good idea. I wouldn't write agreements myself. We can't possibly capture the things that need to be captured, right? And, depending on how far in you're going, but when as you start making more and deeper in commitments, it becomes more and more important to have every T crossed and I dotted. And again, the thing about agreements is they're not for when you're getting along; they're for when you're not getting along. And boy, I'll tell you what, when things hit the fan, you are really glad you have it, right?
Steve, this is John.
Yeah.
I got an add-on to that, and you're right. And I encourage everybody to get things documented. This is a true story, and I'll leave out details, whatever, because of confidentiality. But this is this is value to Evan. Is get those partnership agreements. Here's a true story. 1960s, 6 people got together, made a deal. Those people were like, you know, really good. Steve and his good friends. It was more of a general sitting down at lunch. Oh, let's have this agreement. Let's do it. They papered that agreement. 6 people knew what the intent was of that agreement. That's in the 1960s. In 2011, I was brought in for forensics on behind the scenes of that agreement because there was a dispute. That original agreement passed hands 4 times between the parties. I went up against a $1 billion legal department. I got them to reverse their royalty payment decision. This is a $1 billion legal department. They agreed to pay double the royalties retroactive for 10 years because they made a mistake. And what the underlying factor was, and Steve knows about this, is the preponderance of proof. I was able to prove through a chain of documents, not just the agreement, but the documents, the understanding of what the original intent was in the original agreement.
Yeah.
So yeah, first of all, get them papered, get a clear understanding, but boy, that stuff puts gold in your pocket when it gets passed on, because you may do a partner agreement with me now, but if I pass that on to Anessa, it's clear, it's understood, you're covered, go for it.
No, that's really good, John. Thanks for sharing that. Yeah, that's an important piece of it. And anytime there's a change to some aspect in that agreement, change the agreement, right? Don't let agreements get stale. Don't let them sit in the background and you know, gather dust. Where, you know, well, we said it was 10%, now it's 15%. Well, you never documented that. Now you got a problem like John's talking about. Years from now, somebody can come back and say, hey, you know, I never got my 5%. You know, that makes sense? All right, gang. Well, no other questions. We'll move on. I appreciate everybody's time and stay safe. We'll see you next week. If anything
Just
comes up.
one thing to add, Steve, just, you know, I know you folks are used to me saying document, and Steve and John also, but the other time where these type of agreements, having the documentation and the historical proof, of course, are in your exit, or if you're trying to raise capital, because you want a contract that is also transferable, that, you know, gives the value to your acquirer, so don't miss out on that part. And that's why you would want legal counsel to review, simply for things that you might not have thought of, like transferability.
Yeah.
But yes.
Yeah, that's a great point, Anissa. Thanks for adding that. That's really, really good. Yeah.
Yeah, being in the middle of due diligence and all of a sudden coming up across contracts that do not have a transferability option, it's just like, oh boy.
And think about it this way.
That.
So think about it this way. So you're in due diligence, right? So roll the clock forward on whatever you're doing. Remember, there's going to be an exit no matter what, right? So now you're going forward. You're sometime in the future. You're trying to get your company valued maximally, right? And you're able to say, hey, you know, I've got 27 distribution channels. These 5 are referral channels. These 5 are value-added resellers. These 5 are something else, so on and so forth, right? Versus, yeah, I got a whole bunch of people who refer to us. Which is more valuable, right? It's the documented relationships, right? Plus, you're giving those other people another opportunity, right? The acquirer now has an opportunity to go to those contracts and upsell those contracts, right? Remember the lawn care company, the reason that I got the value I got is because the buyer understood that I already had 135 service contracts. He didn't need to get those. I already had them. He was buying those from me, right? So he could go to them and now upsell them on lots of services that I did not offer. If I didn't have those contracts and I was just going around cutting the same people's yards every week, I would have still made the same money day to day, but I wouldn't have had any value in my business. Right? All right, gang.
That makes sense.
Thanks, everybody. Appreciate your time. Have a great week.
Thanks,
you.
Steve.
Bye.
Have a good week.
Bye-bye.
Everyone.